Hello and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton, the Inflation Guy, and I am your host on this CPI day for May. We're featuring the April CPI report today, and we're going to talk about that on the podcast. But before we get started, I just wanted to thank our sponsors. This episode of Sense and Sensibility, like so many for so long now, has been sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies, perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. That's simplify.us, and you can find their entire lineup of ETFs at simplify.us/ETFs. And, of course, this podcast is also sponsored by Enduring Investments, which was founded to help institutions and individuals defend your money. Our unique strategies can help you if you are saving for your own retirement or for a group of retirees in Quebec. We can also help with managing and hedging supply chain cost pressures if you run a business. Visit us at enduringinvestments.com. So this report today, and I guess the reports are always about framing, but sometimes you get a report that is super obviously bad or super obviously good. Today's report is one of the more normal reports that has some good and some bad. And the overall figure was almost exactly on consensus expectations going in. Actually, the headline was a little bit softer. Economists, the mean consensus on Bloomberg was for 0.37 on the headline, and we got 0.31. Consensus was for 0.30 on core, and we got 0.29. And so you would look at that and say, wow, economists are so good. They just nailed it. Except what that really means is that the good errors and the bad errors kind of offset each other. It's a little bit like, sometimes you have an item that doesn't move because there are no forces acting on it, right? The cup is sitting on the table. Other times you have something which doesn't move because there are great big forces operating in both directions on it, like a tug of war. And the ribbon in a tug of war in the middle of the rope has great forces pushing on both sides or pulling on both sides of the rope, and it doesn't move a whole lot, but that doesn't mean that there weren't, big changes, big forces. And so today's report is a lot like that. Yes, the economists got the number right, but I think if you'd sort of asked most of them to kind of give you the breakdown ahead of time, you would have seen some pretty bad misses. At some level, that doesn't matter. We're not really trying to call the little itty-bitty pieces, but it's important to keep in mind. There are still major shifts going on underneath the waves that we need to kind of keep an eye on, because it's those things underneath the surface that are what will drive kind of the next move. So the good news is, hey, the 3-month average core inflation fell. The 6-month average core inflation fell. The 9-month average, never mind the 9-month average. The 12-month average, the year-on-year rate fell for core inflation. But we knew that inflation was falling, and we knew it was declining. We've known that for a year. And so the markets got really excited at this number that was effectively exactly what was expected, because it shows year-on-year inflation declining as expected. And but that isn't the real state of the debate. The debate is not whether inflation is accelerating or decelerating. We know it's decelerating. The question is, and has been for a long time, how far is it decelerating? How far is this deceleration going to go? If you rewind to last year, there were people who said, hey, by the middle of 2024, we'll be at target. And that obviously was ridiculous. It's not close to right. And, we have core year on year is down to 3.6%. So, roughly double double the target. Not quite double the target. And so it's coming down, but the question has been, how far is it going to come down? How fast is it going to come down? And it's been playing to form. It's been playing to what I've been expecting would happen. And as a consequence, my ultimate forecast hasn't changed. I still think we're going to get median inflation to settle in between 3.75, I always say high threes, low fours. In the late third quarter, fourth quarter of this year, we might get a little bit below that because of what's happening to rents. But then it's going to bounce back up and we're going to end up in the high threes, low fours. Now, I could well end up being wrong on that, but that's been my story now for well over a year. And so far, there's not been anything that sort of causes me to change that view. Now, median inflation came in at 0.348, so a bit above core. That's actually, in a way, it's a little bit of a good sign because we had core a little bit above median, and that's sort of a signature, as I've stated on this podcast before. The signature where you have the long tails to the upside, where you have core above median for a period of time, is a signature of an accelerating inflation economy. So the core being back below median is sort of the direction you want the tails to be in, is to the downside. That, and again, this is consistent with decelerating inflation. But year on year, median is down to, with today's report, 4.48%. And the deceleration has been slowing. It took us, it took us 4 months or 5 months to get from 7% to 6% in median inflation. And it took another 7 months to get from 6% to 5%. And we have gotten from 5 to 5.5 over the next 5 months. So we're still making progress, but it looks like we're going to end up, if you had to look at it, you kind of guess high threes, low fours, which is, again, that's been the story. That's continuing to be the story. Now but again, this comes down to framing. Okay, so all of that, this number on the headline, on the core, on median, is playing to form. Let's look under the hood. The main culprit, I guess, on the deceleration side this month, we kind of knew going in, and that is, again, used cars, where, ironically, I think that the fact that auto insurance, motor vehicle insurance was up 1.4% month on month again this month, and is up more than 20% over the last year. And if you've renewed your auto insurance, you know this. And I think that's actually one of the reasons that the used car prices and even new car prices, although that there's another phenomenon happening there, but especially with used car prices, one of the reasons that they have continued to decline longer than I think, certainly than I expected, is ironically partly because of inflation in other places. That is insurance. If you're buying a car, the affordability of buying a used car has gone down a lot. Even so, we had the price spike associated with COVID, and we knew that used car prices would decline from there, but they've continued for a lot longer. And part of it is that right now, if you go to buy a used car, they're still a lot more expensive than they were pre-COVID. But also, you check into insurance and you're like, the insurance is a lot more expensive than you thought. And so that, unlike with housing affordability, right, everybody has to, one way or another, you have to put a roof over your head. That's not true of cars, right? If you have a 2020 Honda, you don't have to trade it in for a 2022 Honda, or swap out your older car for a newer car. You can always go another year. And so affordability on used cars, I suspect, is a bigger impact than affordability on housing. But anyway, because of used cars and new cars also fell 0.45% month on month. Core goods actually declined from on a year-on-year basis from minus 0.7%, so 0.7% year-on-year of deflation, to minus 1.3%. And that's the lowest year-on-year core goods deflation, the lowest inflation, the biggest deflation in 20 years. It was 2004, the last time we saw core goods deflation greater than that. And actually, other than that episode in the early 2000s, you got to go back a long, long way. It might not have ever happened that we had core goods deflation this deep. Now, again, that's, a lot of that's, cars, and it's a little quirky. It's hard to believe that we can continue to have core goods deflation that strong unless the dollar keeps getting stronger and stronger and stronger and stronger. And that's obviously part of what's going on. And part of what's going on, obviously, too, is that this is the reversal from the COVID spike. And so you get the bullwhip in the other direction. It's gone deeper than I thought it would. But I still think, the bottom line is still that you're not going to drive disinflation from here, with core at 3.6 and median at 4.5. You're not going to get additional disinflation from here on core goods. Now, I said that last month, and we obviously got additional disinflation from core goods. But if minus 0.7 to minus 1.3 was a surprise, it's going to get even harder to get to minus 2, minus 3, minus 4, right? So that gets to be, we're squeezing more and more blood from that stone. And I am as surprised as anybody that the stone is bleeding, but you do run out of that. So you have to look at the core services side. And the core services decelerated to 5.3 year on year from 5.4, but that's still pretty darn high, right? So, and that's with airfares declining 0.8% month on month. It's car and truck rental was down 4.6% month on month. Health insurance, which had been a consistent ad for the last 6 months or past year, is now back to normal levels of about 3.5% per year on a month basis, and so that tends to lower core services inflation. But rents are continuing to decelerate. So owner's equivalent rent was 0.42 month on month versus 0.44 last month. Primary rents 0.35% this month from 0.41%. And I'll say more about rents in a second. But on the other hand, you have hospital services continuing to accelerate and approaching now 8% year on year in hospital services. And that's something to keep an eye on, because if you look at the super core, which is core services X housing, then you end up with then what you see now is you actually see reacceleration on a year on year basis has gone on now for 5 or 6 months. And so even though some of that was from the health insurance bit, which is going away, but a lot of it is from these other things. It's from hospital services, right? So there's a lot of medical care stuff in there going on, and super core is supposedly what the Fed cares most about. So, but don't sleep on medical care. Don't sleep on super core. That's kind of still the bad side of these things. Now let's talk about rents for a second, because you have to talk about them all the time, because they're so gosh darn important. Part of what, the big debate at the Fed and the big debate elsewhere has been that Well, the reason we think inflation is going to decelerate is because rents are going to go into deflation, right? So last year, that's one of the reasons everyone said, oh, we're going to be back at target in the middle of 2024 was because all of these advanced measures of rents were screaming deflation. Now, you have to spend all of about 10 minutes talking to an actual landlord to know that that was just, those numbers were just not, it was not plausible that broad rents across, across the country, across all sorts of metropolitan regions, owner-occupied, single-family, multi-family. It was never plausible that these were all going to go into deflation or even deflation on average for a couple of reasons, one of which is that demand for housing, both owned houses but rents as well, is robust. The supply of homes out there is very low relative to the demand. The supply of rental properties, while people are building more of them, is still not keeping up with the demand because, again, remember we have 6 million more people in this country than we did a couple of years ago. And I don't know who's going to pay for all their roofs. Maybe the government is going to pay for some of those roofs. Don't know, but they have to have roofs, right? You can't, you're a migrant. You can't live in a tent for 6 years. And so that's demand on the housing side. And on the cost side, if you're a landlord, your costs have continued to go up. Your costs for materials, your costs for labor, your costs for utilities have gone up and up and up. So you're a landlord and you're facing higher costs and no end to the demand, and you're telling me that the landlords in that circumstance are going to start cutting rates, cutting rents. That makes no sense. And you can take your little model, you could take your rental data and strip it out and look at it 6 ways from Sunday. I'm going to be skeptical because it just doesn't make any sense. Okay, it just rationally, it would be really hard to get that outcome. And in fact, rents are they're decelerating, but they aren't decelerating very fast. My model has rents year on year, primary rents getting down into the twos by very late this year, but then accelerating again. Home prices, which got into slight deflation, are accelerating again. There's really no reason anymore that for economists to look at rents and say, well, that's going to be the source. That's going to be how we get back to target. There's just no sign that rents are going to get back there and stay there, okay? No matter how you look at it, rents are hooking back higher. So you're an economist. You see these core goods are at minus 1.3%. All right, I'm not going to get a bunch more out of that. I have rents that are going down, but they're not going to go down. They got to get down to 2% or better because super core is going up over 4% and rising. So how am I going to get, just looking at the pieces, how am I going to get inflation back down to the Fed's target? Around 2. You're a little bit below 2, a little bit above 2, depending on whether you're looking at PCE or core. You're not going to get median anywhere close there, but median tends to be a little bit higher than core anyway. So where's it going to come from? And there's just no place you can sort of look at and say, well, okay, obviously it's going to come because what? Okay, because motor vehicle insurance is eventually going to stop inflating. Okay, that's true. But also used car prices are eventually going to stop declining, and they're a bigger percentage than motor vehicle insurance. So anyway, so that's kind of where we are. And you can frame the good news, you can frame the bad news, however you want. And people, the Fed will, at some point here, I suspect that while I can complain about the fact that inflation is really not coming down to what their target is, the Fed is looking at other things other than inflation. It's clear that growth is slowing, and maybe they believe that rates are a little bit above neutral. And so I think they're going to come up with some argument over the summer, and we may well get a rate cut. Now, from my perspective, if I'm on the Federal Reserve Board and the Federal Open Market Committee, and I'm not voting to cut rates, okay? But because I believe that inflation should be the only goal of the Fed, the only target, because in the long run, you maximize employment by having low and stable inflation. But that's not the way they think. And so I think that we're going to have, and at the last Fed meeting, they drastically decreased the rate of tapering of the balance sheet, which is a sign that they're becoming more dovish. So I think over the summer, you're going to get a Fed cut. And maybe they'll phrase it as kind of, front loading, so they don't have to do one during the election, right before the election or something like that. Or just getting back to neutral or something. I don't know what the messaging will be. But I don't think we're about to see an extended easing cycle unless something really bad happens with growth or something really bad happens with some sort of financial crack up. Best you can see is that the front of the curve is going to get a little bit, rates will go down a little bit from here. On the inflation side, there's not a good reason for it. But I think there's enough here that they will make an argument that they're more comfortable. They see rates, they see rents decelerating and blah, 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 blah. Anyway, that's where we are. You get an on expectations print from CPI, and you can look at the components lots of different ways. To my mind, this was roughly as expected to a lot of the different subcomponents as well, but there is still a lot of divergence, divergence in the distribution of underlying price changes. We've got a number of items that are still inflating at better than 5%. We have a number of items that are in deflation, mostly core goods. And so the distribution does not look like a nice bell curve. There's all kinds of stuff happening all over the distribution of elements of the CPI. One final comment on that, and that is that's kind of how inflation looks. I haven't mentioned this in the podcast for some time, but way back when inflation was kind of going up and everybody said transitory, blah, 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 and everybody would look at the one thing that went up that month, a point that I routinely made, and again, I haven't made this for a while, is that that's what inflation looks like. Inflation is not until you get to like high levels of inflation, 10%, 15%, inflation is not all prices going up in unison because vendors don't change their prices every day. And so what inflation looks like is the popcorn kernels in the microwave popcorn bag. A kernel pops, another kernel pops. It's not always the same kernel. It's different kernels every time, but eventually the bag gets full. And the only way to stop that is to stop applying heat. The Fed has stopped applying heat to the bag, but there's still kernels popping. And that's why we continue to get some things like hospital services. Those kernels are still popping. So we're still in an inflationary environment, even though we're seeing disinflation. And that's what tells me that we definitely had a spike, and we are definitely coming down, but there's no real sign yet that those kernels have stopped popping and that we can placidly go back to a 2% rate of inflation. We're going to end up on a median basis in the high 3s, low 4s, after potentially a small deviation below that later in this year. And that's all that I have to say about that for this month. Hey, take a look at my blog posts on inflationguy.blog if you haven't before. Some similar content to this podcast, but some different content as well. And you can subscribe to that blog. And of course, all of this stuff is free I do put out a quarterly inflation outlook, which you can subscribe to at the blog. That costs some money. And actually, it'll come out this Sunday. But otherwise, everything that I do on this podcast, this blog, are for free. But if you have an inflation problem, if you should visit Enduring Investments or message me at inflationguy@enduringinvestments.com. Follow me on X at inflation_guy. And defend your money. And if inflation is coming for you, remember, you know a guy.